Welcome to our new audio cast we call Occasional Weekly Thoughts. LRG Wealth Advisors hopes you find these commentaries helpful. I'm LaRue Gibson, Managing Director and Chief Investment Officer for LRG Wealth Advisors. Please visit our blog at lrgwealthadvisors.hightoweradvisors.com for more timely investing, market, and economic commentaries. Please do not forget to share this content broadly and to subscribe to our YouTube channel and our podcast, or to follow our social media accounts so you never miss information to help you live the life you imagine. Let's briefly discuss the recently much maligned concept of diversification. For proponents of diversification, reducing the risk cost of performance using bonds is an accepted method to attenuate the fluctuations of a portfolio. Historically, investors have practiced diversification using bonds for decades. Savvy investors accept lower returns for the risk reduction characteristics of bonds happily. However, these same investors worry that size and style equity investing that offers diversification lacks value. Size and style equity investing has been difficult since the Great Financial Recession. It isn't that the risk cost for a unit of performance isn't significantly lower. It is. It's that the absolute performance of a well-diversified portfolio has perpetually lagged since the Great Financial Recession when quantitative easing began. Quantitative easing, low borrowing rates, and expanding deficits from fiscal spending have short-circuited the traditional business cycle. Tried and true equity diversifiers, such as value investing, small-cap strategies, private equity, and equity hedging strategies, to name a few, have disappointed versus growth strategies, large-cap stock investing, and passive indexing. Data suggests that any underweight position in the 7 stocks, popularly referred to as the Magnificent Seven, carries significant performance costs. However, our nearly 4-decade tour of duty in the investment markets has taught us that stock markets have a mean streak. That is, for the non-diversified equity investor, stock markets will eventually revert to the mean, possibly with quite a high price tag in risk units, otherwise known as losses. As Aesop's fable of the tortoise and the hare teaches us, the race does not always go to the swift, but to the steady. Thanks for your attention. We appreciate the confidence you have in our financial planning and investment management practice. We invite your thoughts and questions.